is here. We are redefining what it means to sit at the girls' table. Welcome back to The Girls Table, a podcast where founders, creators, and investors share their stories. Today, I'm joined by Jeff Mars Jr., who is the founding partner of ChapterOne. Jeff began investing in 2016 as an angel and scout for Index Ventures. He was a seed investor in Dapper Labs, Compound Finance, The Graph, Dharma Labs, and more. Prior to VC, Jeff was a VP of Product and Revenue at Tinder. In the role, he led the revenue team to #1 top grossing app in the App Store, from $20 million to $1.2 billion in ARR, and managed the business from the early days of monetization up until IPO. Jeff, thanks so much for coming on today. How are you doing?
I'm doing great. I want to use that introduction for all my Zoom calls so I can just, when people are like doing intros, it's just like click on that button and hear that intro.
I love that. I'll send it over. Well, I'd love if you could just give a little background and tell us a little bit more about your transition from being in the operations side of things up until angel investing and then becoming the founding partner of your own VC fund.
Yeah, I guess going back to my childhood, grew up in the Bay Area, so I was born and raised in Menlo Park. And I say that because I was always around technology and had friends' parents who worked in the industry and just sort of had an interest in technology growing up by being in surrounded by it all day long. As you mentioned, I'll skip a lot of the hard parts of my career, which might be interesting. But I ended up at Tinder as the VP of Product and Revenue. Lucked to be there as the business was growing, and dating is notoriously like a very great place to be on a revenue team because it's a category that people pay for. But that experience went well. We ended up becoming the top grossing app in the Play Store and App Store. And through being the person working on subscription revenue, the internet was transitioning from ad-based models to subscriptions, and we were the top grossing app. So people looked at me as being this monetization and product expert, which I appreciated. But as a result of that, just had access to a lot of different opportunities as an angel investor, and kind of transitioned that to being a scout for Index Ventures, as you mentioned, and eventually had enough conviction in my interest in investing was so strong that I decided to do it full time. I launched the fund in 2019, was Fund 1, although we incorporated in 2015. And yeah, in terms of launching the fund, it was, I always believe that like your MVP is a blog post. And so I just wrote a blog post and said I was launching a venture fund. And then, I was mostly doing smaller angel checks, but I had a name, right? And whatever you do, if you give it a name, it starts to feel like a company. And so I started to take it as seriously as I would any other part of my life, my professional life, and really viewed myself as a venture capitalist just because I came up with a name and launched a website. I didn't have LPs at the time, but nobody seemed to care or ask. And, I started to take pitches and kind of was an investor at that point.
Yeah. So before we jump into your angel investing journey, you mentioned that you had struggles before you kind of started at Tinder. And I actually would love to hear those struggles. So I guess, what did you want to do going into college, and what were some struggles that you had early on in your career?
Yeah, definitely. So we're both in LA, so it's probably a pretty typical story. I wanted to be a screenwriter actually in college, and went to grad school at USC film school to be either a producer or a screenwriter, but ended up falling into screenwriting. I wrote a script that got optioned while I was in film school, and then a manager assigned me who was the producer of a movie I love called Garden State. But I was and then a producer at Sony optioned the script. But the whole point of it is like I quickly was in this world of screenwriting, and I had my heart broken pretty bad because we rewrote the same script 5 times, and I wasn't getting paid for the rewrites because I was this young person with no leverage in the industry. And I wrote a couple more scripts that did not get optioned, and then I decided there's probably a much better way to express my creativity and build things, and that led me to software. I had done some tech internships in high school, so I was broadly familiar with what happened at a startup. But the younger version of me wanted to be a screenwriter, and I had my first couple startups were failures too. So there were like moments where I thought I wasn't going to make it in this industry, and I think it's important to say that because a lot of people read what you do online and just assume that it was really easy, but it was the opposite. It was really hard for me.
Wow. So then you're at Tinder, you're working there, now you're in software, and then on the side is when you started angel investing through different syndicates.
Exactly. Yeah. I just started while I was at a startup before Tinder. I went on AngelList and just connected my bank account and was doing $1,000 investments. So they were not big investments, but it was enough where I started to see how long the feedback loops were in venture capital. And so my first investments were in 2013, I want to say. And really, some of those companies still haven't gone public or shut down. Like they're still kind of like figuring things out, which is just amazing because you think about success in venture capital takes a long time in most cases. And so it was, but that was a good, I always tell people like go start investing. If you can become a scout, if you can join SPVs or what, like however you do it, just like do it within your financial, like whatever financial situation you have, just like get going and build a track record and see if you enjoy it and see if founders want to work with you too, because that's important as well.
Yeah. So then you started being a scout for Index Ventures. So what did this entail and what was your main role?
Yeah, so again, this was the time I was at Tinder, kind of like the growth revenue person on the team, and I was came in to be their crypto focus scout, and so which made me unique at the time because in 2017 there weren't that many people who want to be crypto scouts at a venture fund like Index, and so I primarily did, although I did end up doing some non-crypto too, but it was probably 80% crypto. But I ended up investing in a couple projects. Some of them were as angels, but in that fund, I invested in the Graph, which has done really well. And simultaneously, as an angel, around the same time, I did a seed investment in a company called Dapper Labs, which made crypto kitties and ended up becoming the same company that launched NBA Top Shot. And so there were some successful investments. One other was just compound finance, which ended up kind of creating this whole DeFi category. So there were some good breaks early on in crypto for me. Yeah, and but there was one other crypto focused scout. He wasn't pure crypto, but Dylan Field from Figma, who I've heard just did an amazing job because I think he invested in a few things that really worked as well.
So then how did you go from being a scout with Index to ultimately starting your own fund?
Yeah, so I launched this in a syndicate on AngelList, and I'd done I think 10 different SPVs or so, and just literally was bored at work and emailed my group of LPs and said, "Hey, I'm thinking about starting a venture fund," because I was frankly tired of doing SPVs because they are kind of a pain in the butt to organize and get together. And a handful of them said, "Would love to invest." I think I raised like $1 million just through that first email, which $1 million in a venture fund isn't a lot of money, but $1 million to me at that time felt like $100 million. Like I was like, this is amazing. I can now go invest in because I was mostly doing like 25, 50K checks. I was like, I can go invest in 20 companies and this is going to really be, an amazing starting point for a fund. And end up raising more capital. So we ended up getting up to $10 million in that first fund. But it was just, I think I see a lot of younger investors now who they come to me and they say like, hey, I want to raise a $20 million fund. And I don't want to discourage them, but I'm kind of like, do you need to do that? Like you can also just go try and raise, $1 million, which again, it's still $1 million. Like that's not a non-trivial amount of money, and see if you can prove out your thesis, see if founders want to work with you, and try to institutionalize your fund. So when you want to go raise a bigger fund from, family offices, fund of funds, endowments, like you feel like you're ready to do that. But it's kind of like raising the pre-seed versus I see a lot of people going to the Series A before they do the pre-seed, which it's also really hard to return capital. And for most the more money you raise, if you go from 1 to 20, even at 20, you're having to write much bigger checks. And so I think a lot of people forget it's hard to. This is a very tough business, and it's So
No, I want to hone in on that because that's so important. I mean, our fund right now is 25 mil. It's funny because we actually started as a syndicate as well, kind of similar story. We let our LPs know that we're raising a fund. We went through our networks and was able to raise 25 mil, but it's a funny because it's kind of similar. And I do hear a lot of people as well come up and want to raise these 10 million. I've had people come up and say their first fund will be 100 mil. So there's a lot of different variation between what people want to raise as that first one. But how were you able to get from that $1 million, that initial kind of interest that you had from your first LPs in your syndicate, to then raising $10 million and closing out your fund one?
yeah, so I ended up having the good fortune. I had a pretty big fund of funds come in. Fund of funds are funds that invest in venture funds, but they invest in a large number of venture funds, and that's their what they do all day long. And so we had a very well-known fund of funds come in. But the real answer is like right when we raised that first, I didn't start deploying until we had raised I think like $3 million, but I just started investing. And so by the time I was going to LPs, once you activate your fund, this is kind of in the weeds, but you can keep your fund open for a year post activation. So you can also raise a smaller amount. We invested in a couple of companies that did quite well out of the gates. So it was Pipe, Misfits Market, and Sunday Lawn Care, which all did very well. By well, I mean they like raised a lot of money pretty quickly and continue to do so. But so those companies ended up doing well enough where when I went to LPs, they kind of knew they at least had a good idea of some assets they would be investing in. So it wasn't like, hey, this is Jeff and his promise of ways going to invest. It's like, hey, Jeff already got us in these couple deals. So I always tell people also to go start investing. The trick there is I made the mistake of some of those first checks, I kind of sized them to be like a smaller fund, and then you end up raising more money and you wish you'd done bigger checks. And so if I were to do that over, I would say be a bit more aggressive with those initial checks and maybe do like larger than you think your fund's going to be, because if you fundraise over your, over your target or somewhere near the top of your target, you'll wish you'd done kind of bigger checks and had a bit more ownership.
And so, what fund number are you on right now?
We are on fund two, and I say we because we've now built a team, but it's still super early and we're about 50% deployed through fund two and starting to think about what's next as well.
Yeah, and a lot of people don't talk about the process of raising from fund one to fund two because I think you were lucky, as you mentioned, you had a couple up rounds already and some investments that were doing well. But how was that process going from fund one, where not necessarily a lot of the startups were having any type of liquidation events, then going back to investors and raising fund two?
Yeah, I think again, like the timelines were 2019, kind of end of 2019, we raised fund one. Then in 2020, 21, around like summertime, we raised fund two. I say this some self-awareness that like all funds that deployed in 2019, 20 were probably had pretty good marks going into 21. And we had we were marked at like a 5x when we went to market, somewhere near there. Obviously, like big difference between those marks and what the reality of the market is today and what those valuations might be worth. But we had a very good track record, and I think I went back to LPs with like a fairly small fund relative to what they were seeing in the market. So we set up to raise $40 million, and we could have raised, I think, something much bigger. And in fact, we had to cut down our investors by all of them by 50% of their desired allocation beyond our anchors. So there was a lot of demand at the time for what we were doing, and we felt like we had a good story. I think we communicated the desire to build a team, which was, I think, relative to some newer managers, I think a lot of the solo GPs who were coming out at the same time kind of wanted to stay small and solo, but we really aspired to build something bigger than any single person. And so I think that was also felt more institutional to a lot of LPs as well.
Yeah. And what is your fund thesis? And is Fund 1 and Fund 2 have the same thesis and investments structure?
Yeah, I think Fund One was really a generalist access fund. Like, hey, we're going to invest broadly across early stage startups that consumer B2B, but I tend to go towards on the B2B side at least tools for product managers, designers, and engineers to help them build software more efficiently. Just because I'd been on product teams my entire career and had, I'm always shocked at how hard it is to build software. It's just painful and a lot of the workflows are very antiquated. But on the consumer side, I had a really good nose, I think, for things in crypto, and had an interest in the space. And so the consumer we do is now it's almost only crypto, but it's really things in products that have some foundation in a strong community. So the word I think we use is like products that have like cult-like following, so cults, and also products that have really defined business models. And so one thing that I learned coming out of Tinder is it's really great if you know how you're going to make money. And subscriptions within Web2 consumer are obviously an incredible business model. Then Web3 and crypto are so based in financial use cases that you don't need huge networks to make a lot of money for a network or protocol. And so I actually think this is broadly pretty misunderstood amongst limited partners. Like Web3 and crypto businesses can cash flow very nicely and have very great business models with a small amount of users, which is pretty interesting.
And how do you feel right now? Obviously, with FTX and the crypto market as a whole, it used to be kind of the new hot thing. Everybody wanted to invest in Web3. I mean, we're a Web3 crypto fund as well. So, where do you see the future going? And have you had any kind of backlash from any LPs, or have you switched your thesis at all given everything that happened kind of in Q3, Q4?
Yeah. I think the biggest thing is just to acknowledge to LPs that we have similar concerns and frustrations with everything that happened last year. And fundamentally, it's not why we wake up excited to support founders in the space every day. And that the core of what happened was a centralized actor. Well, there were multiple incidents, but usually one or two individuals who took advantage of their position of power to do things that to commit financial crimes. And so we acknowledge that that's the severity of everything that happened, and it was a huge step back for the ecosystem, and especially all the institutional capital that was eager to come into crypto. I think now they're asking themselves, do we want to risk our reputations to invest in not only to invest in venture funds, but to put money in the ecosystem as users. So do we want to explore DeFi or different use cases for our institutions? And it's been a tough couple months for the entire ecosystem. The reality is we just got back from Denver, and there were 25,000 people in Denver who you would never know. Like the headlines that you read in the Wall Street Journal or wherever else, like just do not impact these builders. They're so motivated, and so much of their identity is being a part of this ecosystem that you just walk away inspired by their resilience and really like motivation to make things, I guess, to not only make things right, but to make this a bigger part of the world in the broader financial ecosystem. And so yeah, I think we're still really excited about the space. We acknowledge last year was a huge setback for crypto, and if anything, it's motivating for us to find founders who want to solve the problems that led to FTX and Three Arrows and everything else.
Yeah, and I would agree that ETH Denver definitely, it didn't seem like it was slowing any builders down. And something that you really do at ChapterOne is kind of find the earliest companies and that end up being truly successful. So are there any key characteristics you see in companies and founders that early on?
Yeah, I think generally we gravitate towards technical backgrounds. So we're a pretty, our team is a data scientist, product, more kind of like software backgrounds. And so we look for founders who have shown they can ship software at scale. And so I think if you look at probably like the average age of our founders, it's probably slightly older than most crypto investors. And it's not to say that that younger founders can't build successful companies. It's just we find right now in this crazy time that something about experience is especially important, where these founders are just like calm and collected and willing to get through the bear market. We've seen a couple younger teams who just are so psyched out by the headlines, which is like totally reasonable because you wake up and it just feels like the world is like falling apart in crypto some days, but who have transitioned to either building companies in AI, which I'm sure that's going to be a more common story, or something else, and we're fine with that. Like we, at the end of the day, don't want anybody to waste their time, but I think a lot of people, we find like the kind of like more seasoned founders are able to get through this, and then um, I look a lot at kind of founder market fit. So, um, what's unique in your background to solve a problem better than anybody else in the world, really? Because, so what are the life experiences you've had, industry experiences, and really kind of place value on that. But yeah, I'd say those are two things we look for right now.
Yeah, and we're seeing a lot of people going out and raising, either trying to raise up rounds, a lot of down rounds. But in your opinion, what are some common mistakes that you're seeing early stage startups actually make, and how can they avoid them?
Yeah, the single biggest mistake I see right now is mistaking top line metrics for being something that Series A investors will care about. So when I say top line metrics, downloads, installs, those are kind of like Web 2 versions, but in Web 3 it'd be like unique wallets, or maybe like more like vanity metrics would be like airdrops claimed, or like mints, number, like especially like free mints or anything like free, just discredit. I think crypto has had a lot of go to markets that have really interesting, because you have tokens, you can quickly acquire users and create networks from scratch in a really compelling way. But when you kind of look at the data, a lot of times the retention just isn't there. And so I think a lot of our founders, we have to really work with them to figure out how their cohorts are behaving. A lot of them don't know what their CAC to LTV ratio looks like. So what does it cost to acquire a customer? How much are you going to make over that customer over the lifetime of them being a user? And that's just because a lot of this is actually, it's not because they don't want to measure this. It's because it's actually hard to measure in crypto, because a lot of users, identity is very hard. A lot of users aren't willing to sign up with their email address. Most users have many wallets for different use cases, and so um, you have kind of like this data science problem for kind of like pairing different wallet identities together. Uh, but yeah, and then I think just broadly, I think it's really easy in Web3 and crypto to think you've made a lot of progress, which maybe within our ecosystem you have, but if you broadly look at the 5 billion users on the internet, and you're looking at your MAU, your monthly active users, and maybe it's 1,000 or 5,000 users, it's just such a small slice of the broader internet that it can be hard to get non-crypto native Series A investors excited. So if you're pitching, I don't know, Sequoia or Benchmark, like these kind of like tier one, um, more classic venture funds, it's maybe those metrics don't translate as well to what they're looking for.
Yeah, and I want to switch to the VC side of things too, because you're looking at these companies and you are more early stage. So how do you gain a level of confidence to invest? And what is your due diligence process usually for companies that you're looking at?
Yeah, I think we do both pre-seed and seed, and pre-seed broadly is pre-product, and then seed can be pre-product, but oftentimes does have some data or something we can at least download and play with, or sign up for. I think what we really look for, and again back to kind of that founder market fit question, is just like one unique insight as to why, like either why the founder is building the company or what learning they have. We call it like the earn secret. I got this from Mike Maples at Floodgate. It's just like what secret have you earned in your lifetime, that's informing the startup you want to build. And so, I think the classic Airbnb example I think was they had been going to a conference in Denver. It was I think a designer focused conference, and the hotels were always sold out, and they were sleeping on each other's floors. And they're like, wow, there should be a marketplace to facilitate peer-to-peer lodging, and they earn that secret. But I see a lot of founders. I talked to one of our founders today, and it was just like, hey, it's a lot easier to build, especially in consumer, a successful company if you're building almost for yourself or a problem that you've experienced in your life. And I worked at Tinder for a long time, and Sean Rad, who was our CEO, always talked about how he's more on the shy side, and he actually had problems going to bars or wherever you go meet people and talking to people. Like he didn't love to go to that bar to meet somebody, and he built Tinder for himself to solve a very personal problem he was experiencing. But so I see in crypto especially, there's so many projects that are like incremental derivative projects that aren't really solving like a mass market problem. And you talk to the founders and you're like, why are you building this? And they're kind of like, well, I think it might be interesting or cool, but there's not like a really like deep insight there, um,
Mhm.
informing how you're going to build a company that's going to transcend to hopefully like the rest of the world and beyond like crypto native audience. And so we look a lot. I'm probably like a little bit contrarian within our industry for saying this, but like I actually really value Web 2 experiences. I think and maybe it's because I worked at Tinder, but I think having seen scale is really helpful because
Mhm.
you realize how big the internet is and how global your users will be. And it kind of takes you out of like building for users in, you know, Silver Lake or Brooklyn. You're kind of like, hey, maybe there's users in, I don't know, like Asia or LATAM or somewhere else that should be finding value in my product too. And that's what is needed to go build a like a truly generational company.
Yeah. And you came from operations originally. Do you see yourself going back to the operations side of the house and building a company, or do you see yourself staying on the investment side?
Yeah, I kind of think of ChapterOne as being like a startup that I obviously helped build, and so it feels very operational. We're like literally we set up a printer yesterday in our office, and I say that because just to like show you how like much of a startup it is. We don't have a ton of infrastructure like other venture funds might have. But yeah, I miss operations. I think the thing I mentioned earlier around feedback loops is really, when you launch a product at a company like Tinder, you're effectively launching a product to, 50 million, 60 million users at a time. And that can be really, on a human level, really satisfied because you hop in a Uber, you go to I don't know, you go to like a restaurant, you talk to your waiter or waitress, and like they're using the products that you built, and they have feedback, and you feel like that's just like a really cool feeling.
Mhm.
And you don't get that as much in venture, but you do get a lot more diversity in terms of the problems that you're trying to help solve for every day. Um, Being like, you all probably have like 30 or 40 companies. Each of those companies has a slightly different problem they're trying to solve at any given time. And so helping, but you're more like a coach or a support. You're not the builder. And I think a lot of VCs kind of think that they're the ones who are building the companies when in reality, like the founders are the ones who are doing the real hard work. And so yeah. So I do miss building, but I also view ChapterOne as being a startup, and do love working with many different founders.
Yeah, I mean, I definitely hear both sides where it's a startup in itself, but you don't really see that reward and that effect until way later because you don't know if your startups that you invested in are going to be successful. You could be holding them for 10 plus years to even see a liquidation event. So, where do you see the future of ChapterOne?
Yeah, I think we're going to continue evolving in terms of the categories we invest in. We're very thesis driven, and our thesis for the current fund has been largely around user-owned networks and a need for rebuilding trust on the internet. And we think a lot of that can be accomplished through decentralization and crypto networks. But the funds that I actually admire the most tend to be non-crypto native funds, which is um, I think surprising to some people because like I really admire Union Square Ventures is a good example. Like they do a lot of crypto, but it's not their only thesis. And I think I I see ChapterOne evolving to be more than just crypto over time, but we kind of have to earn that right to do more as a fund. I do think that the generalist fund as an emerging fund manager, that approach is really hard right now in the market because it's just so freaking competitive. And we found that focusing on a vertical or an industry is really creates a more compelling product for founders. Um, and we view what we're doing as being building a product for founders, really. And so if you were to try and build the best product for founders, you probably specialize and verticalize and expand. And so the future for us is expanding beyond just doing Web3 and crypto, but it's probably going to take us a minute to do so.
Yeah. Is there any like emerging technologies you mentioned a few or trends in the startup world that investors should be paying attention to?
Yeah, I mean, I think the obvious one at the risk of sounding like a cliche, there's just so much founder energy in artificial intelligence. And so, um, you know, like value capture aside, I think it's really interesting how consumers really use and understand AI like out of the
Hmm.
gate. Where my wife's dad is 75 and works in the hotel industry and came over last weekend and said he was doing PR releases using ChatGPT, and he's the same person who I tried to onboard onto Coinbase to buy Bitcoin probably 3 or 4 times, and still hasn't bought Bitcoin. And I say that not to be bearish on crypto, it's just to give you like a comparison between how easy the onboarding was to try in that product versus buying a digital asset, or maybe how much like the utility was just way more straightforward, right? It's like, hey, he's from Portugal and doesn't understand. Sorry, he does understand how to write, but he's not like the best writer, and it just out of the gate like helped him.
Yeah.
Um, and so yeah, I think AI is obviously the trend right now, but I always just say like go to college campuses and find out what 18 to 22-year-old engineers are really excited about, and they will show you the future. Like they'll show you um, what's interesting, and I think that's what's so compelling about crypto and blockchain technologies is if you go to any college campus right now, there are so many college students who are so excited to build in the space, regardless of what is happening in the news cycle, and that continues to be the case. Like if we run a college research program, and we have researchers from 20 of the top universities. I can tell you because we talk every single week, they could care zero about what's going on in the crypto headlines. Like they are so excited about the space. And um, back to the kind of the limited partners question, I think if you were just like take your limited partners on a tour of any college, like the Stanford Blockchain Conference in August,
Hmm.
they would be amazed at the level of technical talent. And that's what's inspiring to me is just how great the engineering community is within our space.
I feel like I need to try that or look into that. But you mentioned also that you have 20 researchers across different campuses. So is there anything else you do to differentiate yourself as an investor?
I think we've really focused on a stage, which is, I know that sounds like it wouldn't be a differentiator, but a lot of our peers have hedge funds and growth funds and early stage funds, and we have said we just want to be uniquely great at pre-seed and seed investing. And then, I think we've iterated on the product we're trying to build for founders, but we really approach what we do as being a software company built for founders. And so um, like one example we do, which we're really excited about, is at the end of each month, we send our founders an investor update from us on the things that we did for them that month. And so we've created data systems internally where we can track every touch point we have with founders, and whether it's customer introductions or help with hiring. And we try to, that creates the right accountability where I think it's every investment between a VC and a founder is a partnership and should be viewed as a partnership. And we always thought it was like weird how founders send us updates, but we don't send them updates. And so that was, I think things like that just like stand out as being a bit different. And so yeah, I think those, and then we have a really, I think, cool team and helpful team. We hired the first head of talent from A16Z Crypto to come help us with hiring. We just think we try to be really creative with our founder support, but every team, the minute they raise money, they're like, I want to go hire people, which makes sense. Like if you just like sequence like what you do as a founder, you raise money and you build a team.
Mm-hmm.
And so we're trying to build a really great talent engine for founders. And the other thing we try and do really well is just with customer introductions, because you want to hire people and you want to go to market and kind of land your first couple customers. And so we're trying to productize that as well.
Yeah, I think it's important to differentiate yourself as investors because I think as we spoke out, there's so many emerging fund managers, especially over the last few years, that have come up, tried to raise a fund or are raising a fund. And also just getting the allocation is not easy, especially like in this market currently. So is there any final pieces of advice that you have for the listeners today?
Try to, in a bear market, whatever industry you work in, try and take care of yourself. Like exercise, get sleep, eat well. I think the grind is so hard in a bear market that having kind of like a great personal routine, I think is really important. And there are days where I wake up feeling so stressed out, I'd go to the gym or whatever like that daily routine is for you. I've just found that taking care of your mental health right now is really important. And so I hope everybody's taking care of themselves, and we will get through this to some bull market hopefully in 2024, but in the next year or two, hopefully.
Yeah, that was really me this morning. I felt so stressed last night. I woke up this morning. I also hate morning workout classes. I was like, yep, I'm working out. It has to happen. But Jeff, appreciate you coming on. If anybody wants to connect with Jeff, follow him on Twitter. Also, you have such a great just at JMJ. How long have you been on Twitter for? Because that seems so easy to remember.
Yeah, I have been on Twitter since 2007, but I'm not going to reveal how I got the name, but I got the name a long time ago, and I used to have friends who worked at Twitter who, of course, are no longer there anymore, but they were a little bit helpful in getting the name originally.
I love it. Well, I appreciate you coming on. I really saw it. I'm like, wow, you're lucky. That's so easy to remember. All right. Thank you so much, and looking forward to chatting soon. Bye.
Bye.